Well, good morning, everybody. It's great to be here with you, albeit remotely. My name is Sarah Hendy. I'm the Strategic Partnerships Manager here at Blackfinch Investments. I'm based over down in Hampshire, actually. It's not a very nice day down here today, but I hope it's better weather wherever you may be. I'm delighted to be joined today by my colleague Alistair Lewis, and he's one of our Senior Business Development Managers, and he is the Area Manager for Northern Ireland, Scotland and the North East of England. And as Debbie said, today we're going to take a look at the benefit of considering tax efficient products for corporate clients. But as always, before we begin, I do just have to cover off the important information. Blackfinch Investments is authorised and regulated by the Financial Conduct Authority, and whilst all reasonable care has been taken to ensure that the contents of this presentation are true and accurate, no representation or warranty, express or implied, is given as to the accuracy or completeness of the information or opinions contained in this presentation, and no liability is accepted by Blackfinch. Okay, so onto the learning objectives for today. By the end of this session, you should have a better understanding of how a VCT can help extract profits from a company in a tax efficient manner, be able to explain how a corporate management service can reinstate business relief, and know the risks that holding surplus cash in a business could pose. So we're actually going to split the presentation into two sections, as Debbie mentioned earlier. And in this first part, we'll look at corporate clients that are pre-sale of a company or pre-retirement. So I wanted to start by highlighting some of the threats. And I think it is fair to say that a lot of businesses have been having a very hard time recently. And those companies that have been stockpiling the cash reserves. We know that many are also contemplating the future, and a growing number are considering selling up. But the problem is that selling a business can be hugely detrimental to the owner's family wealth, because as you know, all the time they're trading, their company should qualify for business relief, so be exempt from a potential inheritance tax liability. But as you know, business relief is a retrospective relief and it is applied upon death. So should a client sell their company or shares before they die and not undertake any reinvestment of those proceeds into another tax efficient vehicle, then a costly IHT bill could be due. As you know, the shares must still be held at the time of death to qualify for business relief. And although at the moment we know that surplus cash is probably a real blessing, it can also be a problem and end up being treated as an accepted asset, which would see it lose its business relief status when the company is sold. And I will come back to that and look at this in a little bit more detail later. Now, another area to be mindful of is the expansion of it's now called business asset disposal relief, or entrepreneurs relief as we used to know it. So there's been an expansion of the BADR rulings. This was a couple of years ago, and some owners may not be aware of this, so I did just want to cover them off. So shareholders now can only qualify for BADR if they satisfy 2 out of 3 of the 5% ruling. So that's either holding 5% of voting rights, receive 5% of profits, or 5% of the proceeds of sale. And as I said, they must now satisfy 2 out of 3 of these. Shares must also now be held for 2 years before sale in order to qualify for BADR, whereas previously it was only 1 year. So again, that's something that's really important just to double check, because some family owned businesses, they may, when they're making the decision about sharing, split the shares out between their family. So it's really important that you do understand the timescales involved now to qualify for BADR. Another real threat at the moment with so many companies not being able to trade is that the pot of surplus cash they have could exceed the value of the part of the company that is trading. And this could be classed as substantial extent, and it could again lose BADR. I will come back to that again in a bit more detail. Now, lastly here, another threat just to be aware of is around the contract of sale that your clients may enter into. And you should just be aware of some of the potential issues that a binding contract for sale holds. So just to explain that, if a business owner is looking to sell their company and then retain the business relief qualification in order to be able to utilise replacement relief and keep it IHT efficient, then they really need to discuss this with their solicitor before any contracts are entered into, to ensure that they actually enter into a cross-option agreement, not a binding contract. Now, the reason for this is because a binding contract effectively means that there is an obligation to buy, and as such, the proceeds will be treated as cash within the owner's estate, so could be subject to IHT. And this is another reason why it's really important to work in collaboration with your client's solicitor and accountants prior to any decisions being made. So, for those of you who are not familiar with what an accepted asset actually means, well, it means that any assets of a company will only qualify for business relief if it is either wholly or mainly used for the purpose of the business throughout the 2 years preceding transfer, or that it is required at the time of transfer for the future use or purposes of the business. And actually do be aware here, because this future use or purpose does need to not only be demonstrable, but current. There are time restrictions that are applied. So it is really important to just check that. So basically, in a nutshell, any cash which is dormant may not qualify for business relief if it exceeds 50% of the value of the company when it's sold. And Alistair's going to run through some examples of this later to demonstrate this. The other point that I mentioned in the threats was substantial extent. And the rules for surplus cash in a company and qualifying for BADR are very different for those for business relief. So HMRC state that if the value of a company's non-trading assets is substantial in comparison with its total assets, this could point towards it being considered an investment company, not a trading company, and BADR would not be available. So just to clarify this, HMRC deem a substantial extent to be more than 20% of the trading assets of a company. Now, there is also a caveat on the timings, and typically this means that the cash element needs to have been used for the purposes of the company within 3 years of that company ceasing to trade. And again, this is a really good area to talk to accountants about, as they may have or may still be doing the books for some clients that have dormant companies that have substantial cash that they just didn't know how to extract efficiently. And it could be that a conversation about using a corporate management service to get the company retrading and qualifying for BADR could be of interest. Now, we know that business owners don't like to pay tax. Well, actually, who does? But historically, they would have looked to reduce their income tax liability by either investing larger sums into their pensions or maybe paying themselves a larger dividend. So I thought I'd just start by spending a couple of minutes giving a recap on the current situation as it stands today on pensions and dividends. Obviously, we've got a budget coming up very shortly, so there could be changes afoot. We'll have to wait and see, but this is obviously based on the situation today. So as you all know, since the pension lifetime allowance was introduced back in the 2006 tax year, pensions have attracted a lot of attention from the government. And although we're not quite at the all-time low point of the 2016-17 tax year, we are in a position where pension contributions are capped at between £10,000 to £40,000 per annum, depending on an individual's income, or £4,000 if they're in drawdown. And we also currently have a lifetime allowance of just over £1 million. That's 1,073,000 for the 2020-2021 tax year. As with pensions, dividends have also attracted attention from the government, and since the introduction of the tax-free dividend allowance in 2016, the annual tax-free allowance has reduced down to just £2,000 per annum. And once income hits that higher tax rate, the dividends are taxed at either 32.5% or 38.1%, which again is not such an attractive option for business owners who are looking to extract cash from their companies. But with every threat comes an opportunity, and I wanted to highlight some of the potential clients and scenarios where you could discuss how tax-efficient investments could help, obviously once you've ascertained suitability. Now, this isn't an exhaustive list, but it could include business owners looking to extract larger dividends or simply offsetting an income tax liability. It could be corporate clients looking to supplement existing pension arrangements, or those at risk at hitting the pension lifetime allowance. And actually, just on that note, a lot of what we cover off today could also be of interest to senior directors, as they may have share options or share holdings as part of their remuneration package. So do bear that in mind as well. It could be a landlord, it could be a buy-to-let client that's sold a property and is seeking to defer or mitigate a capital gains liability, or just a business owner that may have had their expansion plans put on hold because of first the threat of Brexit and now COVID, and maybe is just seeking to generate a return on their surplus cash that they're sitting on until such times as they can resume their plans. Now, the other area that we want to highlight today is how a corporate management service could help those business owner clients that may be looking to sell. Now, there are several of these available in the market today, if you're not aware of them, and the main purpose is to help clients ensure that their company qualifies for business relief and business asset disposal relief before they sell. And Alistair is going to look at this in more detail shortly. So on that note, I'm going to hand over to Alistair now, who's going to show you how tax-efficient investments could help and explain how a corporate management service actually works.
Good morning, everyone. My name is Alistair Lewis, and I'm the Business Development Manager for Blackfinch Investments here, working alongside Sarah, supporting financial advisors in Northern Ireland. Now, as Debbie mentioned, when we first discussed doing this session, it was standard to get a bacon roll before it, but we're having to do with our own coffee this morning. But hopefully it won't be too long before we can get back across to Northern Ireland and to see it all. Now, Sarah has already outlined some of the issues that businesses face who hold excess cash. And what we're going to do this morning is to consider some planning strategies that can be employed by such businesses in the years prior to exit. Now, we understand that pension contributions are often the first port of call when considering profit extraction from a business. However, there are clearly limitations in what pension contributions can be made. After pensions, the decision then generally is whether to leave the rest of the cash in the business or extract more out. Now, as Sarah has already mentioned, extracting further cash by way of dividend has tax consequences. However, there is a solution which involves utilising VCT or EIS investments in a tax-efficient profit extraction exercise. Could you move the slide forward, please, Sarah? Thank you. Now, in our case study, for simplicity, we're going to ignore investment growth and product charges. So in this example, we have Debbie, who is a business owner and a director, and she draws a salary of £12,500, which uses up her personal allowance. Now, she's already made pension contributions, and she's now considering whether to extract more cash from the business. She decides to take a dividend of £70,000, and after the dividend annual allowance has been taken into account, there is a total of £13,225 tax due. Now, it's this very thing that puts off quite a lot of business owners from doing profit extraction this way. But as we say, there is a solution. Now, VCTs and qualifying EIS investments, they benefit from 30% income tax relief. So to get back all the dividend tax due to be paid, Debbie invests, in this example, £44,083, to be exact, into a VCT. And this gives income tax relief of £13,225, leaving Debbie in a tax neutral position following her £70,000 dividend. The VCT will also benefit from CGT-free growth and tax-free dividends. However, the VCT must be held by Debbie for 5 years. That's the holding period, or else the income tax relief must be paid back. And it goes without saying that she also must be prepared to accept the higher level of investment risk. In this example, then, the residual £25,916 from the dividend that was not invested into the VCT is free cash available. Go on the next slide. Now, many business owners use this tax-efficient profit extraction strategy not only as a one-off, but they'll do this on an annual basis, especially if cash is continuing to build up in the business. In the same way clients make annual investments into pensions and ISAs, more and more clients are making contributions annually into a VCT. So in this example, our business owner, Debbie, she makes a VCT investment of £25,000 each year. Each year, Debbie receives £7,500 tax relief. And after 5 years, she's built up a portfolio of VCTs worth £125,000. She's also accumulated £37,500 of income tax relief. Could you click once, please, Sarah? Now, the beauty is that in year 6, when Debbie makes her annual VCT investment, she can sell the VCT that she took out in year 1, as she will have held that for 5 years by then. And she can now reinvest year 1's VCT into another VCT. So she is effectively getting another 30% income tax relief on the same capital again. And this allows Debbie to keep the dividend that she extracts from the business in year 6. In year 7, Debbie again takes a dividend from the business, but once again gets the tax back from selling the VCT that she made in year 2 and reinvesting into another VCT. So using this strategy means that the dividends taken from the business from year 6 onwards are effectively free capital. So that is a strategy for extracting profits from the business tax efficiently on an annual basis. Next slide. However, the alternative pre-exit is to leave the excess cash in the business. But as Sarah has explained, there is a real risk that if excess cash is held in the business with no immediate business purpose for it, that excess cash could reduce the business relief for IHT, or indeed lose that business relief completely for the business. There is also a real risk that the business could lose its trading status, meaning that upon business exit, the owners could lose out on business asset disposal relief, or entrepreneur's relief, as we used to call it. However, there is an opportunity to safeguard or regain those tax reliefs, and in the process get a better return than cash. This is also an excellent conversation to have with accountants if you have professional connections. They're normally very interested to hear that there is a solution for their business clients who are holding excess cash on their balance sheet, and also one that is a solution that makes those businesses fit for that exit. Next slide. So let's look at a few examples just to show how this works. In this first example, we have a business that is worth, just for simplicity, £1 million. Now, the majority of this business is trading. However, £400,000 of excess cash has built up over time with no particular business purpose for it. And as such, that excess cash is deemed to be an accepted asset. Now, effectively, that £400,000 would not benefit from business relief if any of the owners were to die holding the shares. In relation to business asset disposal relief, it's highly unlikely that that business would attract the 10% CGT rate on exit. The rough rule of thumb that accountants generally work on is that if more than 20% of the value of the business is non-trading, then business asset disposal relief would be unlikely to be granted. Also, the return on the excess cash would be very low or non-existent. Next slide. However, a solution is that the £400,000 excess cash could be invested into the Blackfinch Corporate Management Service. Because the business in this example had a majority of the business trading, once the £400,000 is invested into the Blackfinch Corporate Management Service, it should reinstate business relief immediately. The Corporate Management Service effectively gets the excess cash trading again through being invested in a portfolio of secured asset-backed lending. The whole business is now BR qualifying. There is now no accepted asset. Now, in relation to business asset disposal relief, this is now likely to be granted because the whole business is now deemed to be trading. In addition to these tax benefits, the money invested in the corporate management service will target a net return of between 4 to 6%, improving the return that the business is getting on cash. Next slide. Now, in our second example, the majority of the business is held in excess cash. Only a minority of the business, £400,000, is trading. The whole £600,000 is excess cash. The business would not benefit from business relief at all as it stands because the majority of the business is non-trading. The business also would not be in a position to qualify for business asset disposal relief on exit. New slide. However, again, there is a solution. The £600,000 is invested in the Blackfinch Corporate Management Service, but because the majority of the business was not trading, it'll take 2 years for the £600,000 to qualify for business relief and for the business to regain its trading status. The business will then be in shape for IHT and for a potential exit in future, plus a better return in cash. Now, in this kind of example, when the majority of the business is non-trading, sometimes the business owners are not prepared to invest the whole £600,000 in this example into the management service, but oftentimes they'll invest enough to tip the business over from being in a minority trading position to being in a majority trading position, regaining business relief for most of the business. And that is a much better situation than not getting business relief at all. Now, at this point, we'll bring Sarah back in, considering she's got the slides, control of the slides, and she'll let us know about a real example of this that she'll discuss with us.
Yes, thanks, Alistair. Now, this is actually very interesting because, as Alistair just mentioned, this is a real life scenario. And it was actually given to me by the compliance director of one of the largest networks in the country. And just a word of warning to you all, this was actually a medium-sized but very successful advisory firm based in Scotland. So as you can see, the company had been trading for 16 years. And the principal was looking to retire, and actually he was moving to Spain. He already had identified a property that he and his wife wanted to buy. He had agreed a management buyout with the other advisors within the business. And the expectation was that he would only have to pay ER, as it was in those days, of £380,000. So the 10% of the sale price that had been agreed. Unfortunately, he didn't check with his accountant or solicitor first, in terms of the percentage of the money that was non-trading. And he went through with the sale of the business. And unfortunately for him, HMRC decided that it was an investment company because they had more than that 20% of surplus cash that was not trading. And the result was that he had to pay £760,000 in tax, and as a result, lost the property that he and his wife were going to actually buy in Spain. So just a word of caution for those of you who have medium to large size advisory businesses. Again, we know by nature of your business, you do have to hold surplus cash, but if you are planning to retire yourself, just be wary of the amount that you have built up in your pot. So, oh, sorry, this was just what you could do to resolve it. So what he could have done if the principal had identified the problem, he could have invested some of the surplus cash into the corporate management service. It would have had to have been held for that minimum of 2 years in order to qualify for BADR because it was such a substantial extent. But we could have resolved the issue for him and he could have then exited in the most tax efficient way. So again, just a little word of warning there. So I'm now on to part 2. So what we're going to do now is have a look at corporate clients that have sold a company and are now in retirement. So alas, even after the company has been sold, some of the threats that I mentioned in part 1 won't have gone away. And there are actually some new areas now that you also need to consider. The first, obviously, is if the client hasn't managed to retain BADR and the sale is subject to a capital gains tax. It's not an ideal situation, but as CGT can be deferred or mitigated by using an EIS, it's not insurmountable. Now, the second is actually the threat that gifting or putting money into trust may bring. And as you know, this requires the benefactor to live for 7 years before it's outside of their estate. And I will come back to this in a moment. And then what about those business owners who sell the company and delay in undertaking any replacement inheritance tax planning? As we mentioned right at the start of the presentation, selling a business can have a huge detrimental impact on a family's wealth if no replacement planning is undertaken following the sale of a company. Although clients do have up to 3 years to reinstate business relief, if the worst case scenario happens and the owner dies before reinvestment, a hefty IHT bill could be left for the family to settle. And I'm sure many of you are familiar with the tale of Swain versus Mills and Reeve, where this exact thing happened. And the family, it was 2 daughters, ended up with something horrendous like a 4 million IHT bill to pay. So before I hand back to Alistair, I wanted to just cover off the threat when it comes to IHT options for clients who have sold their businesses. And just for the sake of this presentation, I've not included life assurance policies as they're not relevant to what we're specifically talking about here. So if you have a business owner who has sold their business and is now cash rich, what are their options for IHT planning? Well, they may still want to consider gifting or putting money into trust, and these are valid options. However, for you as the advisor, you need to consider your client's actual position in terms of age, health, and wealth, because the last thing anyone wants is for the client not to survive the required 7 years for gifting or trusts and the money just to fall back into their estate, as is what happened with Mr. Swain. Also, depending on the amounts of money that we're talking about here, you may also need to just be the voice of caution and suggest that you and your client maybe undertake some math just to ensure that whatever the amount they are planning to gift or put into trust will actually leave them with enough of a buffer to cover their own financial requirements. And actually on that point, one of the great facts of life today is that people are living longer. However, with that does come the real possibility of long-term care costs, and this is a huge concern for many families. It's also one of the key drivers as to why business relief investments are thought to be considered more favourably now by so many families and their advisors when it comes to IHT. That ability for clients to retain access and control of their capital while still doing the best for the family from an IHT point of view. So I'm going to hand back to Alistair now, who's going to explain some of the other nuances and ideas of what you need to be aware of and what you can do to help your clients. Alistair.
Thanks, Sarah. Now business sales are an area of advice that we at Blackfinch do work with advisors a lot on. It is also an area of advice that does really provide very big planning opportunities for you to discuss with your professional connections. However, it does seem to be the case from experience that when a business sale happens, the main issue that is often addressed, especially by the accountant, is CGT, it's capital gains tax, and that tends to be the big thing that's focused upon and how to mitigate it. And the solution that is often discussed out of that is deferring the CGT by investing the proceeds into an EIS. Now, one of the main issues with that, well, Blackfinch do provide EIS investments, but one of the main issues with that is that to avoid CGT on a business sale, the whole gain needs to be invested into an EIS. And in most business sales that I've certainly had experience on, the majority of owners would not really be prepared to do that. If you take an example of a business selling for £2 million, that whole £2 million would need to be invested into an EIS to defer the gain if the whole of the proceeds were gain. And also there would be a loss of access to that capital. And in many cases, the owners they've just got that capital. They feel it's theirs. They now have this. So that does tend to be where the focus has been. Now, I have found that most business owners, especially if they get business asset disposal relief or entrepreneurs relief, generally are prepared to pay the CGT and get it out of the way and not defer it, unless they're very old. But that still leaves them with a big IHT problem, because overnight these clients have now got a very large IHT issue. They never had it before. Pre-sale, their business shares benefited from BR, from business relief, but now the cash is in their bank account and is totally exposed to IHT. But from the point of sale, when contracts are exchanged, a 3-year window of opportunity opens up to do probably some of the best IHT planning that they will ever be able to do. For 3 years from the point of sale, they have the opportunity to reinvest some or all of the proceeds of their sale into another BR qualifying investment. And immediately from day one, reinstate the business relief, while providing them access to all of their capital. And this is making use of something called business replacement relief. This can offer a really big opportunity for discussing with accountants and solicitors, because there is the opportunity to review every business sale that they have done or been involved in within the last 3 years to see that if day one IHT planning with access might be suitable for those clients while it's still available to them. Next slide. Just to run through an example, a very simple example, but in this example we have a 70-year-old widower who sells his business. Now, his advisor and accountant have discussed with him the possibility of deferring CGT through an EIS, but he didn't want to lose access to his capital because he just got it. However, nobody has told him that he could save 40% IHT immediately and still have access to his capital. So in the end, he does nothing. And within 18 months, in this example, his health deteriorates and he sadly dies. As a result, once the nil rate bans and the residence nil rate bans have been taken into account, £400,000 of IHT is due to be paid. Now, if he had invested £1 million into, let's say, the Blackfinch IHT portfolios prior to his death, that investment would be immediately exempt from IHT. But as it is, his estate now have a £400,000 IHT bill to pay. Now, again, this is a great opportunity to potentially work with accountants on, and even just to fulfil a duty of care to clients who have sold a business within the last 3 years, that they might avoid a situation like this, just making them aware that they have a limited opportunity to do effectively day one IHT planning with access. Next slide. Now, the Blackfinch IHT portfolios are often used for this kind of client. These are portfolios that are focused on capital preservation and have extremely low correlation to the stock markets, have very low volatility. Now the graph shows, this graph particularly shows the Blackfinch balanced IHT portfolio, which targets 4% net return per annum after all ongoing costs. And the blue line is the performance of that portfolio over the last 5 years against the FTSE 100 in the orange. As you can see, the main purpose of that graph really is to show you that there's a very little correlation between the IHT portfolios that are invested in unquoted shares and the stock markets. Next slide. There are 4 portfolios in total, which target between 3% and 5% net annual return. All are invested in a combination of renewable energy and first charge secured asset-backed lending, both of which are trades that qualify for business relief. Next slide. So in summary, we've looked at different planning strategies for pre-business sale and post-business sale. For pre-business sale, we've looked at extracting excess cash out of the business tax efficiently using either VCT or EIS. We've also looked at the option of leaving the excess cash in the business and how to potentially turn that into trading activity to safeguard or reinstate tax reliefs, namely business relief and potentially business asset disposal relief. We've also looked at post-sale strategies of deferring capital gains through EIS investment. And finally, we've considered day one IHT planning with access through investing sale proceeds into a business relief qualifying investment. These are all, again, opportunities to discuss with accountant and solicitor connections, their business clients with excess cash and those that have exited within the last 3 years. Next slide. The learning outcomes that we've covered this morning, we have looked at profit extraction using VCTs. We've also looked at how a corporate management service can reinstate business relief and also the risks of holding excess cash. Next slide. Now, if you'd like to discuss anything that we've looked at today, do feel free to get in touch. We'll be more than happy to help. Next slide. And as you would expect, Blackfinch Investments have solutions for the areas that we have discussed today. This was not so much about products. This was about really highlighting the opportunities and the issues. And if you'd like to know more about the product range, do please feel free to get in touch with myself. So finally, just thank you for listening in this morning. We hope you enjoyed the presentation, and Sarah and I will be happy to take any questions.